Our first guest this hour is a big one because he's at the desk. He's at the set. He's on the set. Not everyone gets to do that. You know that. Like, this is...
I'm honored.
He's predicting the S&P 500 will end the year at 3225, and that's a 22% drop from yesterday's close. And is that... Yeah, that's really something. Joining us now is Michael Kantrowitz, Chief Investment Strategist, Head of Portfolio Strategies at Piper Sandler. Does it start with a hot number today, do you think?
Does the sell-off start with a hot number today?
Is that what eventually causes it? Yeah.
No, I don't think today's CPI report is going to make or break anyone's thesis for the year. But ultimately, I think it's as these hot inflation numbers of the past, plus the Fed's tightening cycle, plus the fact that banks have been tightening lending standards for well over a year, that combination has preceded every single recession. So we've got kind of the three ingredients, when you look historically, that have been there before a recession begins.
That's not news to anyone, what you just described.
That's true. We all know that spring is coming. We all know that summer is coming, and that will come regardless of whether or not we know it or not.
You don't think that we've had last year, and what do you calculate the drop for the NASDAQ to be last year? You don't think that was because of what you just described?
No, I actually think that while that is, I think, the general view that markets last year went down because we were pricing in a recession that was going to come at some point.
Or a Fed, rising rates.
Well, yeah, and I think that's exactly what it was. It was a bond bear market where equities were the victim, something we haven't seen to this magnitude or duration really since the 70s. So the first impact of a Fed tightening cycle always comes through the market through PE compression. That was the story of last year. The next effect with a lag, the long and variable lag we always hear about, hits the economy about 15 to 18 months later. And I think the large majority of that is still ahead.
Earnings,
employment.
Do you think unemployment goes to what?
We think it starts rising in the middle of the year. Looking at unemployment claims, looking at the unemployment rate.
But in terms of let's just do the headline rate.
So by the end of the year, our economist believes we're up about a percentage point with upside risk. I think
a full percentage point. So if we're at 3.4%, we're at 4.4%.
Yeah, which is minimal. But what we knew throughout history is the things that precede a rise in unemployment are very consistent throughout history. We have again those conditions today. How much will the unemployment rate rise? Right. Some of that is still path dependent. How many more hikes do we get? Will oil spike in the next several months?
How much of this is a function of Jay Powell versus everything else?
Well, Jay Powell, I would say he's one of the legs of the stool that gives us a recession. So I think the Fed has already done enough to put us into a downturn in a recession later this year.
Are you the lowest on the street?
Yes.
Yeah, that's definitely an outlier call, but you're willing to...
I'm making friends.
But you're willing to put it all on the line for that. The only thing I would say is that there would have to be some really big downside surprises to be worse than what is already anticipated by most people. Because that's well... What are the lows? What do you calculate the lows for the S&P? 3,600 or so, or 35?
Last year?
The recent lows since the sell-off, yeah.
Yeah, 34.91.
So we're not only going to get back down to those, but we're going to breach those and go all the way down to 32 and change.
Yeah, which is about a 15% drop in earnings expectations where they are today.